Tim, it's good to see you. I thought this was a good time for the regional banks like you guys, with the net interest income going up on higher rates, still seeing loan growth, healthy credit. What's the story here?
Yeah, no, Sarah, I think you're right about all of those factors. If you look at Fifth Third, we've been around for about 164 years now, and we're having our best year ever in the history of the company. The $2.2 billion in revenue that we generated this quarter is an all-time record for us. We posted a 53% efficiency ratio. Credit continued to be really well behaved, right? We had 21 basis points of net charge-offs as a percentage of total loans. And the byproduct of that is Fifth Third posted the best return on tangible common equity of any of the commercial banks over $100 billion who have reported thus far this season. I think what we're hearing from investors is that it's not the performance in the quarter that they're questioning, it's the macro factors that you were discussing at the top of the show, whether that is the direction of travel on the economy, whether there's another leg to the trade on rates, the impact of inflation on expenses and otherwise.
Deposit growth a little lower than forecast, and people were concerned about the forecast as well on expenses. And those have been really key areas of focus for investors, haven't they, Tim?
Yeah, they have been. Although I think we were clear mid-quarter that we expected to be able to be flat on deposits from an end of period in June to an end of period in September basis, and we did achieve that outcome. And we were also clear that we expect to be able to grow deposits from here, including 1% to 2% deposit growth in the fourth quarter. But there's no question that the deposit markets are more challenging. I actually think expenses are one of the areas where Fifth Third has really differentiated itself. There's not another one of our investor peers who has had lower expense growth over the course of the past 2 years than we have on a cumulative basis. So I feel really good, actually, about the outlook on expenses. It really is a question of when does NII peak for the regionals? What impact does the aggressive action on the part of central banks have on credit performance? And then in our particular case, I think we have another unfortunate example of the impact of the CECL methodology. We have a really excellent residential solar finance business that we acquired earlier this year that's generating really outstanding growth on the back of the Inflation Reduction Act on one hand and the increase in energy prices. But we have to provide for the life of the loan at the point in time that we originate it, which creates a growth math drag as we grow that business over the course of the next year or two.
And on those macro concerns, which are hitting your stock and other financials, Tim, what is your sense of things? Given you're in loans and credit and housing, where do you think we're going in the economy and with the Fed?
Yeah, I make it a practice to keep my crystal ball in the drawer, so I will say that. But, look, if you look at our customer portfolio, there's no sign of a crack anywhere. Our consumer deposit balances, depending on the cohort that you look at, are anywhere between 60 and 80% higher than they were in February of 2020. We really haven't seen a decline there. So consumers are still maintaining really significant liquidity. And on the commercial side of the equation, what we see from our clients and what we see in their financials is that demand remains strong and that they have been able to pass on increases in input costs in the form of price increases. In fact, when we talk to them about where the investments are going in the business, they're nearly all on supply chain or labor productivity. At this stage, they really are not worried about the sustainability of demand. But I think on the other side of the equation, as you said, first principles would tell you that at some point here, given how aggressively the Fed is acting, that the interest rate cycle has to convert into a credit cycle. And the byproduct of that is, I think we have been cautious in terms of the way that we're running the business, in terms of the way that we think about the outlook and how we invest going forward to ensure that in the event that we do get a credit event here, or a recession over the course of the next, call it 6 to 18 or 24 months, that the bank's well positioned to perform through the cycle for its investors.